Why RILAs are exploding in popularity. Latest numbers. RILA stands for Registered Index-Linked Annuity. Now, let's talk right now, not 5 years ago. Regulators and industry research show that the RILA market has exploded. Annual RILA sales hit about $47.4 billion in 2023, up 15% from 2022 and more than 5x higher than 2017. In 2024, total U.S. retail annuity sales reached a record $432.4 billion, the third straight year of all-time highs, with RILAs one of the fastest-growing segments. In 2025, RILA sales hit new records again, about $19 to $20 billion per quarter in the first half, and Q3 of 2025, roughly $37 billion in the first half, and $57+ billion in the first 3 quarters, up around 18 to 20% year over year. Industry analysis notes that annuity sales in general are hitting new highs as Americans look for income security and protection in a world of inflation, market volatility, and uncertainty about Social Security and pensions. Investment news. So if it feels like you're seeing more RILA marketing, you're not imagining it. The money flowing into these products is huge. What is a RILA, Registered Index-Linked Annuity? Smart protection or hidden risk? Have you seen ads saying things like, "Get stock market growth with protection from losses"? Chances are they're talking about something called a RILA, a Registered Index-Linked Annuity. But what exactly is a RILA? Is it a good investment right now, or just another complex product being pushed to retirees? In this video, we'll break down what a RILA really is, in plain English, how it works with buffers, floors, caps, and participation rates, the latest data and sales numbers so you know why everyone is talking about them, the real risks, fees, and fine print you absolutely need to understand, whether a RILA might make sense for your portfolio in today's market. Stay until the end. I'll give you a due diligence checklist you can use before you sign anything. What is a RILA, really? In a spectrum of annuities. Before we talk about RILAs, quick context. Think of annuities as contracts with an insurance company where you put in money and they give you some combination of tax-deferred growth, optional lifetime income, or some form of protection. On one side, you've got fixed annuities. Think of them like a super CD with a guaranteed rate. Fixed indexed annuities, FIAs. Your return is tied to a stock index, but you're guaranteed not to lose principal if you hold for the term. On the other side, variable annuities, VAs. You're in market sub-accounts. You can lose money but also have more upside. RILAs sit in between. According to FINRA, Registered Index-Linked Annuities, RILAs, sometimes called buffer annuities, credit interest based on the performance of an index, but you choose a buffer or floor to limit losses, and in return you accept caps or limits on the gains. And they are registered because they are treated as securities with prospectuses, SEC, FINRA oversight, and full risk disclosure, unlike traditional fixed annuities. So, in one line, a RILA is an annuity that lets you participate in market growth with partial downside protection and limited upside. Not risk-free, not unlimited growth. It's a trade-off. How does a RILA work? Let's say you put $100,000 into a RILA and choose Index, S&P 500 Price Index, no dividends. Term, 3 years. Structure, 10% buffer. Cap, plus 12% over the term. Here's what that means. Scenario A, market goes up, plus to 25%. Your upside is capped at plus 12%. Your account becomes roughly $112,000 before fees. You don't get dividends from the index, just the crediting formula. Scenario B, market goes up plus 8%, below the 12% cap, so you get the full plus 8%. Account becomes $108,000 before fees. Scenario C, market goes down 8%. You have a 10% buffer. Market loss, 8%, is fully within the buffer. Your credit is 0%. Account roughly stays at $100,000, again before fees and rider charges. Scenario D, market goes down 25%. First, 10% is buffered. The extra 15% loss is your loss. You're down about 15%, so your account is $85,000 plus minus fees. That's the core idea. You trade some of the downside for limited upside in a controlled band. Behind the scenes, insurers use derivatives, like options, to replicate this payoff structure, with buffers often around 10–15% and caps adjusted based on term length and buffer size. How RILAs are positioned as an investment today. So, what's the pitch in today's environment? With interest rates higher than they were in the ultra-low rate era, insurers can offer more attractive caps and participation rates. While still building in buffers or floors for downside protection, marketing often positions RILAs as a way to stay invested in equities, but with some guardrails if the market drops. Potentially a middle ground between low-yield fixed products and fully at-risk variable products. Recent educational content from insurers and platforms highlight buffers and floors as tools to reduce loss in down markets. Higher cap rates than many fixed indexed annuities because you accept some downside risk. So as of late 2025, RILAs are being framed as volatility management tools, especially for people within, say, 5–15 years of retirement, who are nervous about another big crash but don't want to move everything into bonds or CD. But that brings us to the crucial question: are RILAs actually a good investment for you, or just cleverly packaged risk? The upside. Potential benefits of RILAs. Let's be fair and start with the legitimate positives. On partial downside protection. Unlike variable annuities where you can take the full market hit, a buffer or floor limits losses, at least up to a point. Research shows buffers like 10–15% are common, sometimes higher, with caps adjusted accordingly. More upside potential than a fixed indexed annuity. RILAs are generally riskier than fixed indexed annuities, FIAs, but can offer higher caps or more participation in the index, since you're accepting some loss risk. Tax-deferred growth. Like other annuities, growth is usually tax-deferred, meaning you don't pay taxes on gains each year, you pay when you withdraw. Customization. You can often choose different indexes, S&P 500, MSCI, volatility managed indices, etc. Different term lengths, 1 to 6 years, are common. Different buffer, floor levels, and caps 5. Optional income features. Some RILAs offer income riders or structured payout options that can help create an income floor in retirement, though these riders usually cost extra. For the right person, that package can be attractive. The downside: real risks and costs you must understand. Now the part that's often underexplained in sales conversations. Regulators have explicitly warned that communications about RILAs frequently fail to clearly explain how they really work, the risks, and the fees involved. Let's break these risks down. You can lose money. A RILA is not like a guaranteed fixed or fixed indexed annuity. If the market falls beyond your buffer or floor, you absorb losses after that point. For example, 10% buffer, market down 30%. You're down on 21%. In that extreme scenario, your protected investment can still take a meaningful hit. Complex formulas, caps, participation rates, and spreads. Your return is limited by caps, maximum credit you can receive. Participation rates, you might only get, say, 70% of the index gain. Spreads or margins that skim off some of the index performance. EC investor testing found that many investors do not fully understand how these features interact or how they affect potential losses. You absolutely cannot just look at the headline number and assume that's your return. No dividends from the index. Most crediting methods are based on price index returns only, not total return with dividends. That means your potential growth may lag the actual stock market, even before caps and spreads. Liquidity and surrender charges. RILAs typically have multi-year surrender schedules, charge surrender fees if you pull out too early, may limit free withdrawals to, say, 5 to 10% per year. If you think you might need a lot of the money in the next few years for emergencies, big purchases, or opportunities, this illiquidity is a big deal. Fees and riders. While some RILAs have relatively low explicit fees, adding income riders or extra features can add annual rider charges, potentially reduce your effective crediting rates over time. Always ask, what am I really paying all in over the life of this contract? Mis-selling and compliance issues. Regulators are watching this space closely. The SEC released an investor testing report in 2023, highlighting concerns about how well investors understand RILA risks. FINRA's 2025 Annual Regulatory Oversight Report flags that communications and recommendations around RILAs have, in some cases, inadequately explained risks and fees, and stresses the need to comply with regulation best interest. There have been enforcement actions and penalties against firms for improper RILA exchanges and recommendations, especially where disadvantages or costs to the client weren't fully considered. Translation. Regulators are worried that some people are ending up in these products without fully understanding them. Regulatory updates you should know, SEC and FINRA. Because RILAs are complex and growing fast, regulators have been tightening rules. SEC Registration Rule 2024. In 2024, the SEC adopted a rule on registration for index-linked annuities and registered market value adjustment annuities, effective September 23, 2024. Key points. RILAs must be registered with the SEC on specific forms. Their advertising and sales literature are subject to clear standards about what counts as misleading. The goal is to ensure investors receive more transparent, comparable information. 2. FINRA 2025 Oversight. Focus. FINRA's 2025 Annual Regulatory Oversight Report specifically calls out RILAs under annuities securities products. It emphasizes Firms must explain how RILAs work. They must disclose buffers/floors, caps, fees, surrender terms, and index limitations. Recommendations must comply with Reg BI, Regulation Best Interest. In other words, they need to be in the client's best interest, not just suitable. So the regulatory trend is clear. More disclosure, more scrutiny, less tolerance for oversimplified sales pitches. Is a RILA a good investment now? Framework, not hype. Here's the honest answer. A RILA is not automatically good or automatically bad. It's a tool, powerful in the right hands, harmful in the wrong situation. Given the current environment, high annuity demand, persistent inflation concerns, market volatility, RILAs are being used by pre-retirees and retirees who want equity exposure but are afraid of a full-blown market crash and are willing to give up some upside in exchange for a limited downside. They may be worth exploring if you have a multi-year time horizon and don't need full liquidity. You're comfortable with some risk of loss, but not the full force of a market downturn. You understand that returns are capped and may lag simple index investing over long periods. You value tax-deferred growth and potential income features within an annuity wrapper. They may be a poor fit if you need max flexibility and liquidity. You're not willing to accept any risk of loss. You'd be better off looking at fixed or fixed-indexed annuities, CDs, or treasuries. You don't have the patience to fully understand the prospectus and crediting formula. Your advisor can't explain the product clearly in simple language. That's a red flag. If your goal is maximum long-term growth, a low-cost diversified stock portfolio might give you more expected return without caps and complex formulas, but with full downside risk. If your goal is sleep-at-night protection, a RILA may or may not be right. It depends on whether its particular blend of buffer, cap, and fees fits your risk tolerance better than other products. Due diligence checklist before you buy a RILA. Before you sign a RILA contract, ask these questions. What exactly is my downside? Is this a buffer or a floor? If the index drops 30%, how much could I lose in dollar terms? What is my upside? What is the cap, participation rate, or spread? How often can the insurance company change those terms? Which index is used, and does it include dividends? Am I tied to a standard index like the S&P 500 price index, or a volatility-managed synthetic index I've never heard of? Does my crediting method exclude dividends? What are all the fees? Base contract charges, rider fees, income or death benefit riders. Any extra administration or advisory fees? What is the surrender schedule? How long is my money locked up? What are the surrender charges each year? How much can I withdraw annually without penalty? How does income work if I turn it on? What's guaranteed? How is the income base calculated? Under what conditions can my income be reduced or lost? How does this fit into my overall plan? What problem is this solving? Sequence of returns risk, longevity risk, or just fear of volatility? How does it compare to other options, FIAs, VAs, CDs, bond ladders, T-bills, etc.? Is my advisor under a fiduciary or best interest obligation? Ask them to show how this recommendation aligns with Reg BI and why it's better than alternatives for you. If the person selling it to you can't answer these clearly and in detail, don't rush. Closing and call to action. So, what have we learned? A registered index-linked annuity is a middle ground product, partial downside protection, limited upside, tax-deferred growth. The market is booming, tens of billions in new RILA sales each year, record annuity volumes as people search for income security in an uncertain world. They can make sense for some investors if you understand the trade-offs and fine print. But they are not simple, and regulators have warned about confusing communications, hidden risks, and mis-selling. Remember, this video is educational, not personal investment advice. Before you buy any RILA or any annuity, talk to a licensed, qualified financial professional who can look at your full picture. If this helped you understand RILAs, do me a favor. Hit like so more people don't get lost in the jargon. Subscribe for more deep dive breakdowns on annuities, retirement, and smart financial decisions. Comment below. Would you consider a RILA in your retirement plan? Yes or no, and why?